That update. Rohit Agarwal is here with us. Hi Rohit, good afternoon and welcome to the newsroom. Since we're talking about the budget, just want to understand what are the trends you are spotting at this point in time. It's a highly anticipated budget. The economic condition is, of course, no new phenomenon for all of us. We're all aware of how the macros have played out over the last many months, what the key issues for the economy for India Inc. are at this juncture. So in the run-up to that, are you assessing any interesting themes, interesting pockets that perhaps could be good bets?
Yeah. Hi, good afternoon. Well, we believe that the budget, though important for the economy and the country, is not the only relevant thing to watch out for, because most of the things are now taken or considered outside the budget. However, it is important. At the same time, we believe that getting into the budget, what we see is some kind of buoyancy coming back, probably in rural India, where you have seen good water reservoir levels. You have seen good food prices, good pulse prices, good milk prices. All of that should lead to better consumption in rural India. At this point, if the budget comes up with something to reinvigorate some side of consumption on the rural side, I think that's where we are seeing some kind of action happening. But if we were to take a 1 to 3 year view, which we generally tend to take, we think that now time has come for some of the mid caps and small caps to start performing. Typically, the reasons for this being, it's not just the flows where we actually have seen flows getting back or coming back into this segment of the market. But if you just take the example of GST across the world, typically it takes 4 to 10 quarters for economies to stabilize, 4 to 10 quarters give or take a few, when things start moving up. After the whole demon and GST, I think it's now we are pretty much close to the world average where things should start looking up. I don't know, maybe a couple of quarters down the line that starts to happen in our country as well. And we think that now it would be a good time for people to start allocating more of their portfolios towards some quality mid caps and maybe some small caps where cash flow generation is good and business models are good.
Okay, all right. Rohit, just want to understand, we've been talking about consumption for quite some time. Last quarter was extremely disappointing when it comes to the FMCG pack. But this time around, while very few companies have come out with numbers, but they have been more of niche segments, perhaps an alcohol company or a paints company or even a Westlife developer, a Westlife which came out yesterday with a very solid volume, with a very solid triple SG growth coming in. So are these niche segments now likely to be the outliers, or do you see the entire consumption theme now sort of bottoming out?
Well, within the consumption pack, if you have a close look, there is wide divergence. The ones that you mentioned, the kind of paint companies, if you look at the paint companies, even during demon or the GST period, their volume growth was close to double digits or higher than double digits. And we tend to make mistake of just looking at volume growth. Most of their volumes are actually happening from the lower end, where they are actually taking market share from the unorganized. So to answer your question, we don't believe that every form of consumption has kind of bottomed out. It would be very, very discretionary, so to speak. The kind of names that you mentioned where it's, for example, retail. Kind of organized retail is a space where we still see consumption happening, but some of the discretionary items is the space where we see that consumption has not come back. So within the consumption space, you'll have to be very, very choosy. Now we have also seen the kind of hikes that the telecom companies have taken. Now that also hits the consumer wallet at some point of time, and that will likely hit the wallet at the bottom end of the consumer consumption rather than the discretionary end. So you have to be very choosy in our opinion. And it would not be correct in our opinion to make a broad-based statement that the whole of the consumer pack has kind of bottomed out.
Okay, Rohit, how are you assessing the numbers that have trickled in so far for Q3, especially in the BFSI segment? We've got most of the big private lenders, private players come out and deliver their Q3 numbers. We've had some HFCs and NBFCs also deliver their Q3 report card. It's The street at least has not been too happy for bigger banks, but overall, how has the universe performed so far?
Well, the universe performance has been pretty mixed, to say the least. You saw one of the recent SFBs come out with its numbers yesterday, and they were pretty good. And they also managed growth with very good control on asset quality. At the same time, some of the larger corporate banks tend to have slipped a little bit either on the growth or on the asset quality matrices. So I think it all depends on the compositions that the individual banks are running. But one thing is very clear, that there are signs that there is some pockets of issues either on the MFI side and some kind of initial signs on the personal loan side as well. But there are also aspects in different banks where they don't see any signs of stress just yet. So to each its own, to the way their books are made, but there is not any broad-based sign that things are picking up, but there is sign that there are pockets of disturbance on the MFI space for sure.
Rohit, request you to stay on with us while we also listening to the management of PNB Housing Finance. The stock is nosediving in trade. It's down almost a little over 10% actually on disappointing Q3 set. Let's hear out what the MD had to say.
Okay, so the NII compression has happened because of 2-3 reasons. One is that we were expecting the capital raise to have happened in somewhere mid-quarter 3, which is now slated for quarter 4. So the average lever during quarter 3 was higher than anticipated. Hence, we borrowed a lot and we are carrying an excess liquidity of 10,000 crores, which compresses my NII by almost 2.3% or 230 basis points on that 10,000 crores. Then what happened was that we did a lot of securitization, which has an impact on the NII because we were a little cautious on the number of times we were levered. We also sold down corporate book, which was a very good quality, worth about 2,000 crores. So that interest income also did not come in quarter 3. Plus, what happened is because of the fear of high lever and the capital raise getting shifted to quarter 4, we slowed down on our disbursements, both in retail and on the corporate side. Obviously, as a strategy, we are going slow. So that also compressed our NII. So there are about 3-4 factors which compress the NII by about 20 basis points on a book of about 70,000 crores on balance sheet. But having said so, the situation has improved a lot from what it was on an average in quarter 3, and we are back in the game in quarter 4. And I think the NIIs will get restored in quarter 4.
Okay, all right. Move on and talk about commodities. We have Atanu Mukherjee joining us as well on the show. Hi, Mr. Mukherjee, and thank you so much for taking time out. If we look at the way the commodities market has played out, there's been a rally worldwide. What is fueling this kind of a demand and this kind of an upsurge in commodities, and which commodities do you think are standing out the most and are poised to outperform?
Thank you. So I think certainly there is an upsurge in commodities starting late October, November or so. And I think in general, the global scenario is still very tepid, right, in terms of the movements of GDP, in terms of movement of the consumption patterns. However, I think there is an amount of relief that's happening, or a sense of relief that's happening in terms of a potential thaw in terms of the trade war between Trump and China. And so that's obviously giving some respite, anticipated respite in terms of the movement of the commodities. I would think, though, that this perhaps could be a leveling off to a higher point in terms of stabilization rather than a rally, a long-term rally. In terms of specifics, And in terms of specifics, in terms of India, if you look at some of the movements in the markets for steel, they have been behaving better starting late last quarter. Things have been improving. Prices of iron ore, for example, although had been moving kind of high in the past 2 quarters, is coming back to more normal terms as the supply side economics shape out better, as well as the demand side tempers a bit in global markets. But in Indian markets, we think that the demand side will become better next year. So I think overall, in the commodity space, it's kind of like getting to stability from the lows it had been. I think also in terms of some of the energy commodities, specifically crude, despite some of the geopolitical disturbances which made some spikes, in general, crude seems to be more on the path of stability at around $60 range bound, +5 or so, or +7 or so. In terms of other prices like gas prices and the commodities around gas, we have been fairly trending down over the past many months or many quarters globally. Henry Hub has been in U.S. has been below $2 of late, and so I don't see overall that you have a rally in commodities per se, but it's more normalization to the mean, which it should be because of thawing of some of the policies in terms of the U.S. and China trade war.
Apart from the usual suspects when it comes to the commodities baskets, it's also the agri-commodities which are also rallying. So with both of these packs, sort of seeing an up move, how should we read into this?
So I think that, like I said, in terms of the commodities, if you look at soybeans, for example, if you look at commodities on the food side like pork, and in global commodity markets, there's been a little bit of rally in terms of expectation of the thawing of the tariff wars. I think that's what is kind of like normalizing it to more baser levels. And again, all the commodities in this case, if it's because of a fundamental shift in a policy stance, would kind of be correlated moving forward, right? And beyond that is fundamentally got to do with the supply-demand balance. And there are things that are happening in terms of supply side in certain commodities which are pushing the price up, right? For example, if you look at commodities in iron ore, there have been some disruptions, of late. That, of course, crude oil, there have been disruptions, and so that kind of like puts some temporary volatility in terms of upward spikes. But in general, the commodities are shaping out to be towards more normal base levels, right? What it had been earlier, rather than a long-term rally, and that's what our analysis and belief says.
Mr. Mukherjee, pleasure chatting with you and getting in a good insight into what's happening in the commodity space. Many thanks for joining us. Rohit is still with us. Let's go back to him once again. Rohit, we were talking about commodities. So in light of that, of course, metals have seen a very, very good up move. Do you think that's likely to sustain? Are there enough levers in place for this momentum that, especially the steel companies, steel-related companies, they have seen? Is it likely to be sustained?
If you look at metals as a pack, metals is not a pack that generates long-term shareholder wealth if you look at a longish period of time. But there are enough periods when it generates stupendous wealth. In the last 6 months, you have seen metal stocks do very well. And for metals, it's best, in our opinion, to take short-term calls if people want to take, rather than long-term calls, because the long-term value creation doesn't happen. So if you are very good at timing the markets and being able to get in and get out, people may want to play with the metals pack. Where we believe in the near term, given that the world is awash with liquidity, if you look at the US, the EU and Japan itself, these three central banks put together are buying about $100 billion of bonds per month. That's a good amount of liquidity which is being there in the market. Come January, after the Chinese New Year, generally there is restocking which happens in the Chinese steel markets. So in general, this is a time when the commodities tend to do well and there is liquidity floating around. At the same time, the US economy continues to do well. And in China, we have heard that most of the commodity related or environment related issues have kind of ensured that the production levels are not very alarming. So if I have to put all of that together, in the very short term, metals may continue to do well. But again, from a medium to long term perspective, that's not a sector that we believe will still create a long term value creation for shareholders.
Okay, Rohit, fair point. Thank you so much for joining us and sharing with us your views on different sectors and how the market is likely to play out over the next couple of, next
Thank you.
few days. Yes, thank you so much.